Good morning, everyone. My name is Michael Crescione, and I'm a partner and co-practice leader of Citrin Cooperman's Healthcare Group. I also work with a majority of the trade associations in your states. Thank you all for joining us on today's webinar, where we will discuss the takeaways of the CARES Act, including key provisions from recently enacted legislation and regulatory changes related to COVID-19 that your home health care agency could benefit from. We'll have approximately 10 to 15 minutes at the end of the presentation for Q&A. Feel free to submit your questions to the panelists. We'll address as many of them as we can at the end of the presentation or throughout. If time does not permit for us to get to all questions, we'll provide to you those responses plus the slides. We have a great lineup of presenters today that have been extremely busy researching everything COVID-19 and presenting both internally to Citrin Cooperman employees and externally over the last few weeks. Actually, when you think about it, it's almost a month now. Crazy. Each presenter will introduce themselves. So now, Kate Broderick will kick off today's presentation. Take it away, Kate.
Thanks, Michael. So I'm going to review the healthcare provisions of the CARES Act with you all today. There are a lot of provisions in the bill. There's a lot of guidance that has been issued by CMS since the bill has gone through. We do really want to focus on the funding mechanisms that are available. So I'll go over some of the other provisions at a high level, but we really want to make sure to spend time on the provisions that are going to provide some supportive funding for you all. So at a high level, there are a variety of provisions that have loosened requirements for providers and strengthened requirements around what health insurance has to cover. So testing, group health plans and health insurers are going to have to reimburse for tests either at an agreed upon rate with providers or if there's no agreed upon rate, then at a cash price, and that cash price needs to be listed by the providers on a website. Preventative services, so group health plans and health insurers are going to be required to cover all qualifying coronavirus preventative services. These services are defined as services meant to mitigate or immunize against the virus. It's sort of an issue of interpretation at this point, what mitigate will mean, whether that will extend to all services related to the treatment of COVID-19 or whether that scope will be more narrow. We have not seen any additional guidance on that interpretation yet. Vaccine cost sharing, that has been eliminated as part of the bill under Medicare Part B. Flexibility around care outside of hospitals. Acute care hospitals are going to have the flexibility during the public health emergency to transfer patients to alternative settings. We've seen that come through in CMS guidance from the Hospital Without Walls policies that they've issued in the past week or so. They've eliminated the 3-hour rule for inpatient rehab facilities, as well as the 50% rule for long-term care facilities, as well as pausing the LTAC site-neutral payment methodology. This provision, 3715, has also allowed state Medicaid programs to pay for home and community-based support services in order to free up capacity within the hospital. On March 30th, CMS issued sweeping regulatory guidance pursuant to most of these provisions. Again, we're trying to focus on the funding provisions, so we're just going to go over these at a high level. One key piece to be aware of, the Medicare sequestration, which started in 2013, has been suspended beginning May 1st through December 31st of 2020. And that will boost Medicare payments to all Medicare providers by 2%. This is not something that people need to enroll for. This is just something that will happen. So that's an important one to be aware of. There will be a 20% add-on payment for hospitals. That's in the inpatient setting, unfortunately. They're going to prevent any reductions to DME payment throughout the emergency period. Reductions to lab reimbursement are going to be pushed off to 2022. The FMAP increase. So this is another important one to be aware of. So the federal medical assistance percentage that is paid to states to support the Medicaid programs will be increased by 6.2%. So for example, in a state like Massachusetts, where the FMAP is 50%, there will be an opportunity for Massachusetts to increase that to 56.2%. What is not clear at this point is whether that 6.2% is going to flow through to providers. Historically, in economic downturns, as sadly people lose their jobs, Medicaid enrollment increases, so Medicaid expenses increase. And unfortunately, in the past, providers have seen rate freezes. So it's not clear whether the states will be able to flow that through to providers, but we're keeping an eye on that. And then finally, the disproportionate share hospital payment reduction has been pushed off until November 30th of this year. Okay, so the Medicare advance payments. Medicare advance payments have begun to go out this week. CMS had a press conference the evening of the 7th that said they've already issued $34 billion in advance payments. So the way this works for the majority of providers and suppliers is they can receive up to 100% of their Medicare payment amount for 3 months in advance in a lump sum payment. Things to be aware of with this. For most providers and suppliers, there's a 120-day grace period following the issuance of the payment. After that 120 days ends, recoupment will begin, which means that Medicare will start to reduce payments to the providers to recoup the advance. Providers then have so in that 90-day recoupment period, if there is anything outstanding after that 90 days, Medicare will issue a demand letter. So that'll be 120 plus 90. On the 210th day, Medicare will issue a demand letter. At that point, providers have the opportunity to repay the balance in a lump sum. If there is any balance outstanding 31 days after that demand letter is issued, that balance will begin accruing interest at 10.25%. So yes, the Medicare advance payments do provide some upfront liquidity, but it is important to be aware, given how volumes are shifting, and this is an unprecedented time, that there is a risk of fairly high interest on any outstanding balance 7 months from the issuance of the payment. And so this is just a visual of how that will work. The payment is made at time 0. There's 120 days until recoupment begins. 90 days after that, anything outstanding that has not been recouped will be due back to Medicare. 31 days after that, that interest accrual will begin. Hospitals have a longer period of recoupment. They have a year after the initial payment date. But again, 31 days after that year, they too will be subject to a 10.25% interest rate on anything outstanding. Another key funding provision. So as part of the CARES Act, $100 billion was appropriated to the Public Health and Social Services Fund, which falls under HHS. This money was specifically allocated to prevent, prepare for, and respond to the coronavirus for necessary expenses to reimburse through grants and other mechanisms eligible healthcare providers for healthcare-related expenses or lost revenues attributable to the coronavirus. Eligible providers here, it's very broad: public entities, Medicare and Medicaid enrolled suppliers and providers, for-profit, nonprofit entities within the United States. But the key piece here is they've called out it is for providers that are providing diagnosis, testing, or care for individuals with possible or actual cases of COVID-19. The use of funds, again, is pretty broad. Lost revenues, It's unclear at this point whether, lost revenues might mean lost revenues from cancellation of elective procedures, or whether it's lost revenues more specifically attributable to COVID-19 and expenses attributable to COVID-19. The key thing here, the guidance is not clear, though we will talk in a second about an announcement that was made on the 7th about an initial distribution of this money. Because there's very little guidance at this point as to, how the entirety of this fund will be distributed, it's very important to keep meticulous records of lost revenue and expenses attributable to COVID-19. So as guidance comes out, you're prepared with the appropriate documentation to request, funding that might be due to you. Timing of distribution we'll talk about in a second. The distribution methodology is very unclear. About a week ago, the American Hospital Association urged HHS to distribute $25,000 per bed to the max in most areas and $30,000 per bed in hotspots. Based on a statement made by Seema Verma on the evening of the 7th, it's not clear whether they're going to follow the American Hospital Association's guidance. What they announced on the evening of the 7th is that the initial $30 billion in grant funding will be distributed this week. Seema Verma stated that it's a no strings attached disbursement, that the dollars can be spent as the health care organizations see fit. The money will be distributed via direct deposit for providers that receive their reimbursement from Medicare electronically. If they don't, there's evidently a basic registration that's required. The distribution will be based on Medicare revenue rather than on a first come, first served basis. It's not clear exactly what that methodology means. They are also aware that, a lot of providers do not get the majority of their funding from Medicare. So there's going to be a second tranche of funding in the coming weeks. Again, the distribution methodology is unclear at this point. They have not issued guidance as to whether Medicare providers and suppliers will all receive a portion of this distribution. Based on the language in the CARES Act, it does seem likely that the funding will target providers that are providing that testing, diagnoses, and care for COVID and suspected COVID patients. But again, this just came out late on the 7th, and there really has not been any additional information as to who might, expect to receive this money. So transitioning gears a little bit, we wanted to spend some time on telehealth, given the sweeping regulatory changes that have happened there, as well as the importance of it, and at this point when we're trying to reduce the spread of the virus. So the Office of Civil Rights has issued some relaxed regulations around certain aspects of HIPAA, such that providers acting in good faith will be able to use services like Apple FaceTime, Zoom, chat methodologies that normally would be prohibited under HIPAA. So this should allow providers to stand up telehealth capabilities relatively quickly. They do recommend using services like Skype for Business or Microsoft Teams, as those products already provide HIPAA compliant video communications as well as BAAs. But there is flexibility there. Under the Section 1135 blanket waiver issued by the Secretary of HHS, the providers who hold a license in a state can provide services in a different state so long as the licenses are equivalent. Bear in mind here that state and local laws still apply, so it's very important to speak with your counsel in terms of standing up anything like that. CMS has not issued guidance yet on how this will be implemented. but it should hopefully provide flexibility, particularly, in areas like the Northeast where patients may live or have gone to different states than where they're normally seen. And CMS, a key piece to be aware of for physical, occupational, and speech language therapy, e-visits are still permitted for those providers, but CMS is aware that there is a real need to provide more robust therapy services via telehealth. For example, the ability to establish a new patient remotely, and they are currently reviewing that. So hopefully there will be additional guidance around those services in the coming weeks. Some additional changes to be aware of. They've relaxed the requirement for Medicare patients to have an established relationship with the provider. They're also permitting audio-only visits and reimbursing for those under the telephonic visit codes. Providers can use telehealth for CKD patients who are on home dialysis. Providers can use telehealth to recertify patients for hospice. They've relaxed the rules allowing mid-level nurse practitioners, et cetera, to certify patients and to recertify patients for home health. They have also changed the homebound definition. So patients that, which is probably true of all of us, patients whose doctors have told them to stay at home to avoid any risk of exposure to COVID-19 can be certified as homebound. Home health agencies are also permitted to do COVID testing. So there's a variety of regulatory changes that have been relaxed. Some reimbursement changes around telehealth. Some key ones, CMS is going to be reimbursing at the same rate as face-to-face visits. The list of reimbursable services has been expanded by 85 codes, setting flexibility. So the intention here is to provide as much flexibility as possible so patients can be seen in any setting and providers can provide from any setting. Medicare has provided the flexibility to providers to waive coinsurance and deductible requirements, and they have also provided the flexibility to Part D and Medicare Advantage plans to add services like telehealth that were not part of their initial bid. So one piece we also want to talk about, this is, again, a funding mechanism. As part of the CARES Act, the FCC was appropriated $200 million for the support of telehealth programming. Late last week, I think it was last Thursday evening, they issued the rules around the program that they're going to be standing up. The application period has not opened yet. It needs to be approved by the OMB, and then they will begin accepting applications. In terms of how they have defined the providers that are eligible for this money, it is fairly specific, and we're looking for some additional guidance from them whether home health providers would qualify for this. It does seem that if a home health provider is in a consortium or has a relationship with one of this, a nonprofit hospital, for example, one of the providers that are specifically called out, that they might be eligible to get a piece of this. But this money is for the purchase of telecommunications, information services, and connected devices. The key piece here is connected devices. The intention is not for example, if you've got a diabetic patient that has an analog glucometer that they would then enter their blood glucose readings. The intention here would be, a digital glucometer that would automatically upload those readings to some sort of portal or electronic medical record. They'll provide full funding for eligible services and devices, but don't anticipate awarding any more than $1 million to a single applicant. The awards can be made based on estimated cost in the application, but to provide flexibility, providers aren't going to be tied to the purchases outlined in their application. And applicants are eligible to reapply if they exhaust their funds. So these funds are going to be awarded on a rolling basis. They will not target specific conditions, patient populations, geographic areas, though there is going to be a preference for the hardest hit areas. Applicants should be documenting hardships such as provider shortages or limited access to internet in their applications. The FCC will consider programs' ability to directly aid in the prevention of the pandemic spread as an important consideration of the application. And the devices and services funded must be integral to patient care. So in addition to this particular program, they're also going to be standing up their connected care program, which, that's a separate program that they were going to be standing up anyway, but they're fast tracking that, and that's going to primarily benefit veterans and low-income patients. A couple key considerations for any program that is thinking about standing up telehealth capabilities, if you don't have them already. Home health, is an interesting application of telehealth. We're still looking to get guidance on whether there's an opportunity for home health organizations to work with provider organizations and get a piece of that provider reimbursement. We haven't seen any guidance on that yet, but we've reached out to CMS and are looking to get some additional guidance there. So some key things to be aware of: cybersecurity and compliance. It's important to speak with counsel as well as cybersecurity experts to understand risk exposure and mitigation strategies. Malpractice coverage. So, is telehealth covered under your insurance? Bookkeeping, given again the kind of fluidity of some of the guidance around these funding mechanisms, ensuring that you're setting up separate cost centers for telehealth, but also for other expenses that you're incurring around COVID-19, just to be able to really carefully track that and make sure that, you've got the documentation in place to advocate for any kind of funding, either through state or federal mechanisms that you might be due as part of the emergency. Staffing, is there an opportunity to streamline staffing by scaling using telehealth? Commercial reimbursement, are you working with your commercial payers to understand what they might be reimbursing for? So with that, that kind of wraps up the healthcare provisions, and I will hand it over to, we just had one question come in. Okay, so will the audio-only visits be allowed by nurse practitioners in Medicare Part A certified home health, and are the codes the same as the Part B codes? Let me double check on that to make sure I'm getting you the right answer, and we'll come back to that at the end. So I will hand this over to Mitzi to review the provisions under the PPP, as well as some of the other loan provisions.
Great. Thanks so much, Kate. I really appreciate it. You certainly are a wealth of knowledge in many areas that I have very little experience with. So hello, everybody on this call. My name is Mitzi Hollenbeck. I'm a partner out of the Rhode Island office. I'm a CPA and a certified fraud examiner, and I've been kind of running point along with a number of other individuals in the firm on the Paycheck Protection Program loans and the EIDL loans that are coming from the SBA as part of the CARES Act. Just to kind of make mention, and we'll touch upon the EIDL program second to the PPP program, which seems to be really the area that's garnering a lot of attention, and it's a lot of curiosity because this is the forgivable or the potential forgivable loan that exists that's coming through the CARES Act. But just to let you know that the EIDL program through the SBA is actually a longer term program that has been in existence for a long time, and it's kind of been altered and kind of pushed into the PPP program a little bit through and by way of the CARES Act. So I think, the first thing just to mention for everybody on this call, and Kate said it perfectly, and I certainly wrote it down and quoted it, it was one of the first things that she said, was that pretty much everything within this act seems to be an issue of interpretation. And what I mean by that is the fact that constantly the parameters around this Paycheck Protection Program loan have been changing on a rapid basis. The latest the updates that we got from Treasury really came through last night. So there's been a lot of confusion around the program. And we still have a lot more questions than we necessarily have answers for. But we do know that as of this moment, some of these loans have already been funded and people are receiving these loans. And we will kind of continue to keep you guys updated. If you subscribe to our COVID-19 updates, those you would be able to get directly sent to your inbox, and they'll kind of give you all the updates as to what we know once we know it. So to give you an idea, the Paycheck Protection Program loans, these are the loans that everybody's talking about today. And these are loans that are designed to be for small businesses, typically under 500 employees. They don't require any collateral and they don't require any personal guarantees. And the first thing to kind of note is really when we look at this calculation of how you determine what the number of employees are, and specific to the industries in which you participate in, it's important to note that the number of employees is calculated based upon the average pay period. So it's not necessarily the number of W-2s that you happen to be paying out in 2019 for most people. It happens to be the number of average employees you have every single time that you pay your employees. So for example, if you have, healthcare workers that are only working, maybe 26 different weeks out of the year, you're paying people on a weekly basis. Those individuals are not counted as an employee for purposes of the average number of employees on the weeks that they are not working. So that's, a determination that needs to be made because a lot of individuals, I think, initially might believe that they don't qualify for the program based upon the number of W-2s that they issued in the previous year. The other thing just to keep in mind with regard to the Paycheck Protection Program and the eligibility criteria. So again, there are certain industries which do allow for you to have more than 500 employees calculated, as I mentioned before, as the average number of employees per pay period. And again, typically it's calendar year 2019 for most businesses. There's different calculations if you're seasonal or if you have become a new business that was in effect prior to February 15th, 2020, if you started your business after January 1st, 2020. But that being said, there are affiliation rules that you do need to be aware of. If you own or control other entities within your structure, that could kick you over the 500 employees for purposes of being denied eligibility under the Paycheck Protection Program. So that's something to keep in mind as well. The bottom line is that this program is essentially designed by the government as a way to keep your employees employed. And there's a calculation that's determined for the amount of loan that you are eligible for based upon your average payroll times a multiple of 2.5. And that's your average monthly payroll times 2.5. The maximum loan under the program is $10 million. And the definition of payroll as to what counts in terms of calculating this average monthly payroll is a calculation of your gross wages, which if you pay any individuals on an annual basis more than $100,000, you cap their annual salary at $100,000 for purposes of your division by 12 to get to your annual or your monthly payroll. And it also includes things like group healthcare insurance coverage, health insurance premiums. It includes any payments of retirement benefits. One thing to note in some of the frequently asked questions that have come out in the past 2 days, any payments you make to 1099s or independent contractors are not included in your calculation of payroll costs. Those individuals are considered to be sole proprietors or Schedule Cs, and independent contractors are able to apply on their own for the program, actually beginning tomorrow. So this loan is a potentially forgivable loan. And what I mean by that is if you actually use the proceeds during what's known as the covered period, which is 8 weeks after you receive your first disbursement of the loan. And that's kind of a key to note is the first disbursement of the loan, because what we found out last night from the SBA and from Treasury is that it appears that if you do get qualified for a loan and you aren't eligible, you may not receive the entirety of the loan up front. We do know that we've had clients that have received the full amount of their loan has already been funded into their bank accounts, but the way that they kind of came out last night and indicated that your covered period for paying eligible expenses will start the day you receive your first disbursement. The last disbursement they have mentioned in some instances may be as late as 2 months after you file or you receive your initial disbursement. The timing of the receipt of the funds is fairly critical because you only have 8 weeks once you receive these funds to use it for covered expenses if you are looking to potentially apply and get granted loan forgiveness under this program. For the loans that are not forgiven, the interest rate on the loans is scheduled to be 1%. There is a 2-year repayment period. You have no payments due on these loans for the first 6 months. This is a program that is administered through the existing SBA's 7A program, which is going to be administered by the SBA, but it's issued through the member banks. So if you haven't heard about this program, you haven't talked to your bankers, we certainly suggest that you talk to your bankers to see if your bank is a participating SBA lender. If not, the SBA's website does have a listing of those eligible lenders so that you can take a look and find one to apply for this program. So let's talk a little bit about the loan forgiveness under this program. So you may be eligible for forgiveness of this loan, provided that you utilize the funds that you're granted for qualified and covered expenses. So the main items that you can use these expenses for, mainly payroll. The definition of payroll is the same between the application of the loan and the calculation of the amount and what can be used for covered payroll under the uses of the loan, with one exception that we are not sure. And again, ambiguity, issue of interpretation. It appears as though you are able to borrow based upon gross payroll. It appears the uses of the payroll may not count to be used for employee withholdings with regard to federal withholding tax, as well as FICA and FUTA payments. So that is something that, again, I think we'll see some additional guidance on as this moves forward into the loan forgiveness period. Everybody right now is more concerned with the calculation of the loan. You have to use at least 75% of the loan proceeds for payroll costs in this 8-week covered period. The other costs that are eligible for use under this loan program include interest on mortgages that you have entered into prior to February of 2020, also includes rent payments or utilities payments. So again, these are eligible other expenses other than payroll. And again, the payroll costs are defined as they are in the calculation of the loan amount, other than the potential for the federal withholding taxes. So in order to qualify for loan forgiveness, you do need to ensure a few things. You need to make sure that your full-time equivalent headcount has not diminished between the time period of February 15th, 2019 to June 30th, 2019, or January 1st, 2020 until February 29th, 2020. During that period to the end of your 8-week covered period. There is an exception out there if you restore your employee count by the end of June 30th back to where it was prior to applying or using these funds for the loan, that you will not have a reduction in your forgiveness. There's a mathematical calculation based upon essentially how many employees you kept on payroll. And if you reduced your payroll, then that percentage of reduction essentially is a reduction of the forgiveness that you're granted under this loan. Another test that you have here is you have to make sure that your employee salaries are maintained to at least 75% of the test period salary in order for that employee to be counted in terms of your forgiveness calculation. Again, one of the big components of this particular loan is any loan forgiveness under this program is not going to be included in your business's taxable income. There is a specific call out for cancellation of debt income that this is not going to be considered as such. So that's a nice relief for any of these companies that are applying for receive the loan, use it for covered expenses, document to your bank appropriately the loan forgiveness provisions, and get your loan forgiven. So that's a very broad overview of the Paycheck Protection Program. There are many nuances that are associated with it. And as I mentioned, we are constantly receiving updates on this program for additional interpretations. How does this apply to my business? How does this apply to my independent contractors? What's the definition of payroll? What are we doing with loan forgiveness? We certainly are following this and will continue to follow this, and we'll certainly be making everybody aware of those changes as they come due. So the next program we're going to talk about, Kate, if you don't mind moving the slide forward. Excellent. So we're going to talk about the economic injury disaster loan for just a brief period of time. This is a loan that's really designed, as opposed to the PPP loan, which is designed to keep your employees on payroll. The economic injury disaster loan is a program that the SBA has had in existence for quite some time. This is a COVID-19 specific loan that you have to demonstrate that you've been adversely impacted by the impact of COVID-19 on your business. But this is a loan that is run and administered through the SBA. You have the similar SBA criteria in terms of eligibility. For most companies, it ends up being fewer than 500 employees. In some industries, you are allowed to have more than 500 employees, and also in some industries, you're capped at a revenue cap in terms of what determines whether or not you are a small business and eligible for these loans. The loan proceeds with this loan program are up to $2 million. The design of this program is for working capital funding. Probably the simplest example between the EIDL program and the PPP program in terms of allowable uses is that the PPP program will allow you to pay interest on your mortgage. The EIDL loan will allow you to pay the principal on your mortgage. So it's really kind of determinable based upon your future accounts payable, your operating expenses, payroll past the covered period. You can apply for both loans, but you can't use the covered, you can't necessarily use the proceeds from both loans for the same purposes. They have to be for different purposes. In this particular loan, again, as I mentioned, these slides change constantly because the definitions and rules change constantly. Collateral is now required only for loans over $200,000. Personal guarantees have been expanded on this particular loan. You do need to provide personal guarantees, but real estate collateral loans are required at $500,000 or more. So some of those personal guarantees and collateral components are changing at a moment's notice. In addition to that, the SBA has said that they will take the most preferential lien they can on the remainder of your assets with regard to this loan. This loan has an interest rate of 3.75% for most for-profits, and it's 2.75% for nonprofits that are applying for this loan. Again, the proceeds can be used for working capital, payroll, AP, inventory, equipment. There is no loan forgiveness under this EIDL program. One of the elements, though, that ties the EIDL program back to the PPP program, you may have heard of this, is there's something called an advance grant on the EIDL, which is a $10,000 advance. What came out late last night is that the rules have changed on this as well. This is no longer a $10,000 grant. It is up to $10,000. The SBA has determined that based upon the number of employees that you have, it will be essentially $1,000 of an available grant per employee. So for example, if you only have 3 employees, the maximum advance grant you can get under the EIDL application is $3,000. If you are applying for the EIDL grant and you're applying for the PPP loan will be less than the EIDL grant, and the EIDL amount will be added to the PPP grant in total, can't exceed $10 million. There is a forgiveness provision where if you apply for the EIDL advance grant, you don't get approved for the EIDL loan, then you actually will not be able to, you actually don't have to repay the advance that you've received under this program. The EIDL loan is a loan that I've been told by the SBA is actually, they were going to have a term length on this loan up to 30 years. From what I have been told from the SBA, based upon the number of applications, they are just turning this loan into a 30-year loan for everybody. There's no prepayment penalties, so you can prepay this loan, and it will be over a 30-year period from what we understand. That being said, it's again, kind of an overview of these loans that exist. One other item of note I want to just make you aware of with regard to the SBA programs. If you happen to have an existing 504 loan through the SBA, an existing 7A loan, or a micro loan that might have come through one of their CDCs, you actually have an automatic 6-month forgiveness of the loan repayments. So again, we haven't seen anything from the SBA with regard to whether or not that will be included as part of your taxable income. That is automatic. You shouldn't need to do anything. If you had a loan that was set to be repaid under the 504 program, 7A program, or micro loan on a monthly basis, your bank should not have taken it for the month of April. If they did, you can contact your bank and they will contact the SBA and they will refund that money to you. That being said, I'm going to turn this over to Ron Hecht, who's going to talk about a lot of the intersection in certain cases of these loans with some of the tax provisions, but is going to give you an overview of the tax provisions of the CARES Act. Thanks.
Thank you, Mitzi. Good morning, all. I am Ron Hecht. I am a tax partner in the Citrin-Cooperman White Plains, New York office and co-leader of the firm's high net worth individual tax practice. I will talk about 5 or 6 key tax provisions that we have gotten through the benefit of the CARES Act. And as Mitzi said, some of these will require some analysis because of intersection between these credits and the ability to get the Paycheck Protection Loan. The first section, which is the Employee Retention Credit, is a refundable payroll credit equal to 50% of qualified wages that are paid to employees during the COVID-19 crisis. The credit's available to employers who either operations were fully or partially suspended due to government shutdowns, or their gross receipts declined by more than 50% when compared to the same quarter in the prior year. Now, like any good tax provision, there are a series of tests and a series of exceptions. These rules have been broken up into under and over 100 employee employers. For employers with greater than 100 full-time employees, qualified wages are only the wages paid to employees when the employees are not providing services due to COVID-19 restrictions. Employers with under 100 employees, all wages that are paid to employees will qualify. Now, as I mentioned, it's a 50% credit. The credit applies only to $10,000 of wages per employee. So it's a $5,000, effectively a $5,000 per employee credit being granted through this provision. And the credit is refundable. It serves first to reduce your payroll taxes that are incurred on your quarterly Form 941. And to the extent that your payroll taxes do not cover this credit, the IRS has released a new form, a Form 7200, allowing you to apply for a quick refund of this credit. This credit cannot, and I'm going to stress this credit cannot be claimed if the employer is taking out a Paycheck Protection Program loan. So the takeaway in this credit is an analysis should be done before any PPP loan application is submitted to determine how much do I anticipate my how much do I expect my forgivable loan to be, and comparing that to how much is this $5,000 per employee credit, and then make a determination which one gives you the greater benefit and determine which route is the best to go. The next benefit is a delay of payment of employer payroll taxes. The caveat here is that this delay of payment is not available if any PPP loan has been forgiven. The deferral applies to all employers other than the ineligible ones I just mentioned. It applies to all payroll taxes that would otherwise be due for payroll for the period March 27th through December 31st, 2020. And the payroll taxes are payable 50% at December 31st, 2021, and 50% at December 31st, 2022, and they are deferrable without interest or penalties. Kate, if we could go on to the next slide, please. Thank you. Some general changes to tax law that are designed to put additional cash into businesses' pockets. The net operating loss rules were changed under the TCJA, the 2017 tax law changes, and back effective in 2018, net operating loss rules were changed that a business that had a loss for years 2018 and forward were not allowed to carry that loss back, but they had an unlimited carry forward of that loss, but the loss could only be used up to 80% of the taxpayer's taxable income. The CARES Act made changes to these rules retroactive to 2018, making losses incurred in 2018 through 2020 eligible to be carried back for a 5-year period of time, and for income earned through the year 2020 can be used against 100% of income rather than 80% of income. The quick takeaway here is that for a business that had a loss in 2018 and was not able to currently take advantage of it, they are now able to file refund claims going back 5 years to get refunds of taxes previously paid. The next provision related to flow-through entities and individuals, where the TCJA, starting in 2018, limited an individual's ability to claim business losses in excess of $500,000. Any of those losses were suspended and needed to be carried forward to 2019 and forward. Again, the CARES Act retroactively changed this as of 2018, suspending this excess business loss provision for years 2018, 19, and 20, and potentially allowing refund claims for 2018 and 19 returns where this provision may have been implemented. The next one that affects businesses that have business interest expense, and again, starting in 2018 under the 2017 Tax Reform Act, a business was limited in the amount of interest that it could deduct. In simple terms, limited to 30% of their adjusted taxable income, the rest being carried forward. The 30% was increased to 50% for years 2019 and 2020. The last provision, and the one that may provide the most potential benefit for small businesses, is an error in drafting the 2017 Act. Changed the depreciation period for leasehold improvements that businesses made, changed it from a 15-year depreciation period to a 39-year depreciation period, and more importantly, based on a technicality, those leasehold improvements were no longer eligible for the qualified leasehold, the businesses were no longer eligible for the 100% bonus depreciation, which would have allowed an immediate deduction for leasehold improvements. The CARES Act changed this for 2018, 2019 to retroactively fix this error, turning these leasehold improvements into 15-year property, making them eligible for immediate write-off, and again, making them eligible in 2018 for potential amended returns, which could qualify for putting some immediate cash into the owner's pockets of flow-through businesses. At this point, I will turn this back to Michael for some questions and answers.
Thanks, Ron. We're just going through some of the questions I have. So I'm going to ask Kate to respond to one of the questions that we received. And obviously, if there's any more questions people have, please submit them and we will address them. So Kate, can you maybe answer the question that came in on the advance payment?
Sure. So we got a question, is it fair to say that Medicare receivables are the collateral for advance payments? So any line of credit with a bank using Medicare AR as collateral takes a back seat. So fundamentally, yes, the government will always have superiority. So I would say that the Medicare recruitment during the 120, 210-day period will take priority over the bank's claim on AR. All that being said, after 210 days, the amount of Medicare payments will be the same as it would have been without the advance payments. So for the banks, it shouldn't really make a difference. And we had a second question that I said I would come back to. Will the audio-only visits be allowed by NPs and Medicare Part A certified home health? And are the codes the same as the Part B codes? So the guidance is evolving. Just want to kind of caveat all of this with that. And for this particular question, state and local scope of practice laws still apply. Supervision rules are still applying. But based on a call CMS had Tuesday evening, they'll be reimbursing providers. That was the language they used. So presumably mid-levels should fall under that for audio-only visits under the codes 99441 through 99443. So over to Mitzi and Ron for some of the questions about the loan and tax provisions.
Yeah, so I think, a couple things, and as Ron had mentioned too, there's an intersection between the tax provisions and the loan provisions. And certainly if you end up being a provider or a company that has under the affiliation rules or greater than, just under your own organization, and you have more than 500 employees as defined by the SBA, and you do not qualify as a small business under the SBA, that, the tax provisions are going to be really your only avenue by which to gain some sort of measure of relief under the CARES Act. As we kind of mentioned with regard to the affiliation rules, again, you have to be a small business as qualified. And so if you own or control, you have similar management, even if you have nonprofits within the structure, they can all be added together in terms of your average number of employees that might kick you over that limit for 500 employees. So you're really left with the tax provisions that Ron had discussed with regard to the payroll tax deferrals, to the employee retention credits. Those are really going to be your way to conserve cash for the most part under the CARES Act provisions. I think, one of the other things that you need to make sure that you're aware of if you do qualify for some of these loan provisions is that under the PPP program, you do need to make a number of different attestations on the application, mainly to the fact that the current uncertainty within the environment and the COVID-19 environment has made the loan imperative for you to allow you to continue to pay your employees. So certifications do exist. They are legal certifications. We believe that we'll see a lot more interpretation of what those certifications might mean on the other side once there's a forgiveness calculation or a potential forgiveness calculation related to the loan proceeds. So again, we're just cautioning our clients to just be aware and, certainly answer truthfully, on the applications. And if you do have any, considerations or concerns related to that, we're here and we're happy to try to help you on that.
Right. Mitzi, one thing that I want to add, since we've been talking about the intersection of these loans and taxes, that we described the forgiveness process on these Paycheck Protection Program loans. Normally under general tax law, if a business has a debt forgiven, that forgiveness is taxable. Under the CARES Act, the forgiveness on these Paycheck Protection Program loans are specifically designed to be treated as not creating taxable income, which will prevent forgiveness from creating income, which would take away some of the benefit otherwise available for these loans.
Yeah, and really to that point, I have not seen anything with regard to, again, if you have an existing SBA 7A loan, 504 loan, or a micro loan where the SBA is paying your next 6 months of payments, I have not seen anything specifically that would call out those payments from being included in your taxable income.
Agreed.
So, some of the questions too relate to what do I need? What does the application process look like for a PPP loan? What documents do I need to bring to my bank? How do I know how I can be prepared? And each bank is somewhat administering the PPP program slightly differently. Some of the information that we have seen banks request, if you don't have an existing lending relationship with an existing bank that you're applying for this PPP loan with, they may require you to provide additional documentation in the form of previous year's tax returns, really to kind of verify who you are, that you are a legitimate business, some collateral looking information they might request from you. But again, this loan doesn't have any collateral associated with it. And a lot of times the banks are just complying with the Bank Secrecy Act and their requirements for Know Your Customer, because if you are a brand new customer to the bank, they may need to do a little bit more of a deeper dive into you. It's not required under the program, and as I mentioned, each bank is slightly different. But if you go to a bank that you have an existing relationship for, typically what they're looking for in order to document and calculate, or really take a look at what your calculation was with regard to the calculation of your average monthly payroll, would be your 941s, your calculation of where you excluded the compensation of employees making more than $100,000, your potentially, they might want to see the health insurance invoices that you've been paying and things like that too. So just be prepared when you apply for this, that is some of the documentation you're going to need. On the flip side, when you go to apply for forgiveness, and again, we haven't seen what specifics the forgiveness mechanism will be undertaken by, but we know that it will be administered through the banks. You need to make sure that you document and show the covered uses and what you actually use this money for. That's going to include things like your payroll records, copies of invoices and canceled checks, bank statements related to, rent payments if you're making them, utilities payments during the covered period. So, proper documentation is absolutely imperative to determining whether or not you're going to get forgiveness under this loan. And we're really telling people that you kind of need to monitor your forgiveness calculation as you go through this covered 8-week period.
All right, well, I've got an interesting question that was asked, and I'm going to go out on a little bit of a limb with my answer. The question was, will the forgiveness under PPP loans be deemed unrelated business income for a not-for-profit? Based on the concept that unrelated business income looks at what would be taxable income if the entity were a taxpayer, I would think that since it's treated as not taxable for a tax-paying business, it should not be unrelated business income for a not-for-profit.
Thanks, Ron. I think we're coming up to the end. I know we might have just one more question. Mitzi, do you think you can handle that, or we'll have to get back to the individual, the one other question regarding TDL?
Yeah, this is actually a great point, and I did not mention this. So thank you for this question. So, a lot of people have been, so under the Families First Coronavirus Act, which was signed into law, I don't know, about at least a week prior to the CARES Act, which really provided that you must pay employees. It's essentially, Federal Family Medical Leave Act under the COVID-19 crisis, where you're required to pay your employees 100% for 2 weeks, essentially, if they happen to be either quarantined or they're sick with coronavirus. So those mandated payments that exist under the Families First Coronavirus Leave Act are actually excluded from the definition of calculation of covered payroll for loan forgiveness purposes for the PPP. The other piece too is when you're paying somebody 60% of their wages because they're home, because they have to care for a child, because their place of schooling or daycare is closed, that payment also during the covered period is not allowed to be part of your calculation of, I guess I would say, eligible payroll for purposes of loan forgiveness.
Well, thank you, Kate, Mitzi, and Ron. I think we've really provided some really useful, insightful information to the group today. So again, we want to thank you for joining us today. And again, if you do have any other questions, please reach out to any of the presenters today and we'll get back to you. Slides or an audio recording of this will be available in the near future. So once again, thank you for joining us. And everyone here, on behalf of Citron Cooperman, be well, be safe, and have a good day. Thank you.